Welcome to the Deep Dive. Today, we're looking at something you see quite often on Wall Street, actually. It's this riddle. How can a company's management sound so positive, so bullish even, while the market just gives it a thumbs down? PPG's second quarter 2025 earnings call, it just happened July 30th. It's a perfect case study for this.
Exactly. It really highlights how, the same set of facts, the same numbers, can spin out into very different stories depending on who's telling it or maybe who's listening.
So our mission today is basically to unpack those key numbers, try to get inside management's head, understand their confident view, but also, crucially, figure out why the market reacted, pretty skeptically.
Right. We'll start with the data, the results snapshot. Then we'll dig into the details, what management pointed to in their operations, their strategy. And then, tackle that market reaction, why the disconnect.
Okay, let's dive in. Headline numbers first, the ones that hit the wires. PPG reported adjusted earnings per share, $2.22 for Q2 2025.
Right, and that was just a hair under consensus. The street was looking for $2.23. So a miss, but a tiny one, like 0.4%.
Very slight miss there, but okay, revenue that looked a bit better, didn't it?
It did. That's where it gets interesting. Revenue landed at $4.195 billion. That actually beat the consensus estimate by almost 0.8%.
Okay, so an EPS miss, a revenue beat, but, and there's always a but, right?
Yeah.
Overall revenue is still down 1% compared to last year.
And management was clear on that. They pinned it mostly on recent divestitures, selling off parts of the business.
Which isn't necessarily bad news, it could be strategic. Getting rid of lower margin stuff to focus on better areas, maybe like aerospace. It suggests a plan for, hopefully, a more profitable future.
Definitely part of the narrative they're building. And looking at the GAAP earnings per share, that was $1.98, and that number was down 5% year over year.
Okay. And segment EBITDA margin?
Came in at 20.3%. That's down 40 basis points, 0.4 percentage points from the same quarter last year.
Right. And what about returning cash to shareholders? Buybacks?
Yep, they were active there. Repurchased $150 million worth of stock in Q2.
Which brings the total for the year so far to $540 million.
That's right, $540 million year to date. So definitely showing a commitment to shareholder returns through buybacks, a pretty hefty amount.
So you've got a revenue beat, significant buybacks. But what happened with the stock price right after the call?
Yeah, that's the kicker. The immediate reaction was, pretty negative. Pre-market, the stock dropped nearly 4%.
Ouch.
And it closed the day down over 5%. And the volume, the number of shares traded, spiked more than 3 times the average.
Wow, so heavy selling.
Definitely. And there was also a noticeable jump in weekly put option volume. That usually means investors are betting on, or at least hedging against, more downside to come. Concern.
Okay, this is where it gets really interesting because that market reaction is almost the polar opposite of the tone from management, right?
Yeah.
CEO Tim Knavish sounded, what did you call it, cautiously bullish?
Yeah, that felt like the vibe. He was pretty explicit, saying the company's finally hit a point where their share gains are really kicking in. And he said he anticipates a much stronger second half of the year.
Okay, kicking in. But did they give specifics? I mean, what does that actually mean on the ground? New contracts, stealing business from competitors?
Good question. They did offer some proof points. Organic volume growth, so growth from selling more stuff, not just price increases or acquisitions, was up a positive 2% in the quarter.
Okay, 2% organic volume growth. That's solid. Where'd it come from?
It was notably strong in a few key areas.
Yeah.
Aerospace coatings, protective and marine coatings, and also automotive OEM, that's original equipment manufacturing.
Supplying paint to car factories.
Exactly. And they specifically called out accelerating share gains in places like China and India for auto OEM. So it suggests a targeted approach, not just riding a wave, but actively winning business.
Right, taking share. Okay, let's dig into the segments then. Architectural coatings, paint for houses and buildings. How did that look?
Still a bit of a mixed bag, honestly. Volumes were soft, especially in Eastern Europe. Mexico was also a drag, though it did get slightly better compared to Q1.
Any bright spots in architectural?
Some. They mentioned positive momentum in the Nordics, the UK, and Ireland. But overall, the segment's margins got hit by a few things. Those divestitures we mentioned, lower volumes overall, currency exchange rates moving against them, and even a temporary supply chain issue down in Australia.
Okay, so architectural is still facing some headwinds. What about performance coatings?
Now, that's a different story entirely. Performance coatings actually delivered record net sales and earnings. Strong organic sales increased there, 6%.
Record numbers,
Yeah.
Nice. What's driving that? Aerospace still flying high.
Absolutely. Aerospace just keeps delivering high single-digit organic sales growth again, and they said order backlogs are stable. They're putting money into it too, investments in operations, capital spending, like a new factory in the U.S. to support future growth, clearly a focus area.
Makes sense. What about automotive refinish, the body shop paint side?
That's a small dip, low single-digit organic sales decrease. But, and this is important context, year to date, it's actually flat.
Flat, even though collision claims across the industry are down.
Exactly. Collision claims were apparently down high single digits, so being flat in that environment is actually pretty resilient. They credit their MoonWalk Link system, that's their automated paint mixing tech for body shops, as helping buffer those industry headwinds.
Ah, the subscription model helping out there.
Seems like it. They are flagging a softer Q3, though, maybe some customer order patterns normalizing, but they expect a broader industry recovery in 2026.
Okay. And protective and marine. Coatings for ships, bridges, infrastructure.
Another strong performer. Double-digit organic sales growth for the 9th quarter in a row.
Wow, 9 quarters of double digit.
Yeah, driven by global demand and, again, those share gains. They highlighted some new tech proprietary anti-foul coatings for ships and fire protective chemistries, things designed to cut maintenance or boost safety. Key differentiators, they argue.
And traffic solutions,
Yeah.
road markings and such.
Also growing mid-single-digit organic growth. They said that's outpacing the industry.
Okay, so performance coatings looking pretty robust overall. Let's pivot to the last big segment, industrial coatings. How are things there?
Industrial volumes were flat, which, compared to recent quarters, is actually a big improvement. They see it as the first real sign those share gains are starting to bite.
So, stabilization maybe?
Feels like it. Auto OEM within industrial saw volume growth in Asia and Latin America, which helped offset declines in the US and Europe.
And packaging coatings. Cans, containers.
That was a bright spot. High single-digit organic sales growth, again, attributed to share gains, but also conversions to new BPA-free technologies, especially in Europe.
Got it. So definite signs of progress in industrial, even if overall volumes were just flat.
Yeah, a much better picture than, say, 6 months ago.
Okay, let's zoom out from the segments and look at the bigger strategic picture. They mentioned a restructuring program.
They did, a $75 million program for 2025. They said they're on track and have realized about 40% of the savings so far this year.
And the rest is coming when?
Expected to ramp up in Q3 and Q4. They think this will help lift gross margins by 60 to 90 basis points. That's assuming raw material costs deflate a bit and the European architectural market gradually improves.
And despite the Q2 EPS miss, they kept their full-year guidance.
Yes, they affirmed the full-year 2025 adjusted EPS range, still $7.75 to $8.05. And they're specifically anticipating high single-digit EPS growth in the second half of this year, with Q4 being even stronger.
That's a confident stance for the back half, really banking on those internal improvements kicking in.
Absolutely. And they emphasize their balance sheet strength, too. Paid off 300 million euros of debt in Q2, got another 600 million euros maturing in Q4. They feel they have the financial flexibility.
You mentioned raw materials. It's interesting PPG is seeing low single-digit inflation, while some competitors are saying costs are flat or even down. What's their explanation for that?
They pointed to a couple of things. One is their larger footprint in Mexico. Buying stuff there with US dollars when the currency moves against you makes things more expensive. The other is exposure to specific materials, like epoxy resins.
But can they handle that inflation? Pass it on.
Crucially, they said yes, at least in Mexico. They stated they have the pricing power there to offset that inflation, so it shouldn't just eat into their margins unchecked.
Okay, that brings us back to the investor context. We know the stock dropped over 5% on the day. It really feels like the market just wasn't buying the management optimism, did it?
It certainly seems that way. That immediate reaction, the high volume, the put activity, it all points to skepticism, despite management banging the drum about share gains and second-half margin improvement.
Investors seem stuck on the slight EPS miss and maybe the ongoing weakness in Europe. It's like that classic paradox, isn't it?
Yeah.
Management paints this picture of progress, and the market just focuses on a couple of smudges.
Exactly that. The sell-side analysts, the brokers, they mostly acknowledged the volume upside, the growth in certain segments, but they also flagged those near-term cost headwinds, and some did trim their price targets on the stock.
But not everyone was selling, right? You mentioned some chatter from the buy side.
Yeah, interesting counterpoint. Some desk chatter suggested certain types of funds, the growth at a reasonable price or GARP investors, were actually using the dip as a buying opportunity.
Their thinking being
That maybe this was just a reset, acknowledging the current challenges, but without a cut to the full year guidance. So maybe the sell-off was overdone.
which creates this real split view, doesn't it? Management focusing on internal drivers, the restructuring, the share gains, the portfolio changes, while the market seems more worried about the macro picture, the year-over-year EPS dip.
Precisely. And PPG is actively trying to change that portfolio, right? Selling off those architectural businesses, the silica unit that freed up cash.
And where's that cash going?
We saw the buybacks, but also bolt-on acquisitions, smaller deals in areas they like, more higher margin, maybe less cyclical niches. Aerospace is the prime example. They're also pushing innovation, like that MoonWalk system or the new marine chemistries, as drivers beyond just waiting for the economy to turn.
So looking ahead, what are the key things investors should watch for? Catalysts.
Okay, well, Q3 earnings in late October, obviously. That'll be the first real look at the full impact of that restructuring run rate. Should give a clearer picture on cost savings.
Anything else product-wise?
They mentioned rolling out a next-generation aerospace top coat in September. That could give another boost to that key segment. And you'll want to keep an eye on China EV production trends. That's a driver for their auto OEM business. Oh, and they hinted at maybe a small acquisition in packaging coatings.
So internal catalysts. What about the macro stuff?
Yeah, that still matters. Things like an inflection in European PMIs, the Purchasing Managers Index showing manufacturing picking up, that would help. And oil prices, which feed into raw material costs, those will always cause swings.
So investors are basically weighing the current valuation against this story PPG is telling, moving from just volume recovery now to margin expansion later, driven by these internal efforts.
Right. And if they execute well, management is implicitly suggesting the potential for mid-teens growth in earnings per share over the next few years. That's the potential prize the CHER investors might be looking at.
Okay, so that sets the stage perfectly for our This Is Not Financial Advice segment.
Yeah.
Given this disconnect, management's focus on internal wins versus the market's macro worries what's an outrageous but plausible trade idea.
Okay, remember, not advice. But how about this? A catalyst convergence long-short pair trade.
Intriguing name. Break it down.
You go long PPG, you're buying into management's story. The accelerating share gains, the $100 million in industrial wins they cited, the strong aerospace backlog, the restructuring savings kicking in during the second half to boost margins.
Okay, long PPG, based on their internal execution thesis. What's the short side?
Yeah.
The hedge.
To hedge against those macro fears, especially Europe, and maybe the general negative sentiment after competitor Sherwin-Williams recently cut their forecast, you could short a proportional amount of Sherwin-Williams SHW.
Short the peer. What's the specific logic there?
The idea is that PPG, with its specific self-help initiatives, MoonWalk, the new marine fire stuff, the targeted auto OEM gains in Asia, plus its deliberate shift away from some architectural exposure and towards aerospace, well, it might be less purely exposed to the general architectural paint softness that really hit Sherwin-Williams and seemed to spook the market about PPG too.
So you're betting PPG's specific actions and diversification make it more resilient than SHW to a broad architectural slowdown.
Exactly. It's a bet on PPG's specific operational leverage and strategy against those broader market headwinds that seem to be weighing on the whole sector. Betting on execution over macro fears, essentially.
That is definitely a nuanced play, focusing on the company specifics versus the sector noise. Okay, that wraps up our deep dive into PPG's Q2 2025 earnings call.
Yeah, quite the mixed bag, wasn't it? A slight EPS miss, but a revenue beat. Underlying organic volume growth looked pretty solid, driven by those key segments and the share gains they keep talking about.
And you got management pointing to a big second half acceleration, banking on restructuring and portfolio moves.
While the market seems unconvinced, still hung up on the macro clouds and that small Q2 miss, a real clash of narratives.
So just a reminder for everyone listening, this analysis is purely for informational purposes. It is absolutely not financial advice. Always do your own homework and talk to a qualified financial professional before making any investment decisions.
Definitely. But it makes you think, right? What stands out most to you from this call? Do you find yourself leaning more towards management's cautious optimism, or do you share the market's immediate skepticism?
Yeah, it invites you to really consider that long-term story PPG is trying to build. How much power do those internal catalysts really have against the broader economic tides? That's the question to mull over as these results settle in. It's a story still very much in progress.